This is lecture 4, Money and the Financial Markets. You will find this material in chapter 3 of Introduction to Macroeconomics by Paul Middleditch. In today's lecture, we're going to define the concept of money, discuss an important macroeconomic variable, which is the supply of money. We're going to look at how money is created by commercial banks, how we formulate the function for money demand, and then complete the financial markets with the market for money and look at monetary policy. We start with the concept of money. Is money an asset or a liability? Well, that depends on the perspective. For those that hold money, it's an asset. For those that issue money, it's a liability. So what exactly is money? We know that money is something that we use in our day-to-day business to carry out the transactions that we need to make. But do we ever stop to think what money actually is? One way to help us define money is to use a statement about a qualification for an asset to be used as money. Anything can be used as money provided it is accepted as money. So long as money is accepted by everybody, then any asset can be used. Though there are 3 qualifiers or conditions that must be met. Money must fulfill the function of a medium of exchange. As we've already said, it has to be accepted by everybody for all economic transactions, otherwise it won't be redeemable by people that hold it. You might receive some money in a transaction, but not be able to use it in a different geographical area. It's no longer money. Money must operate as a unit of account. We must be able to use it to measure value. For instance, when we see a shirt in a shop, there are 2 different shirts with 2 different prices, that price conveys to you a signal about quality. So it helps us to measure things, the price, which is in money terms. Money must provide a reasonable store of value. In other words, it must keep its value stable over time, because if it does not, then we cannot use it as a measuring rod because the rod is changing itself. 2 types of assets that definitely count as money are notes and coins, that's cash in circulation, and electronic money, checkable bank accounts where funds can be used by withdrawing from the cash point immediately for purchases. Normally only very liquid assets can be used as money. And what do we mean by liquidity? We mean the speed at which an asset can be converted into cash immediately for spending. So for instance, some money in a savings account that requires notice is less liquid than some money that's in an account that can be immediately withdrawn. So as we expand our measures of money, we can include less liquid types of assets. If we add up all the money in the economy, then we have a macroeconomic variable called the money supply. And it's an important economic aggregate. It's important because it facilitates economic activity. We need money to carry out transactions. Without money, we have to go back to a barter economy. As I've already mentioned, there's several definitions of the money supply because of the problem of what to include in the definition of money. We know that cash is an obvious candidate for the money supply, but what about less liquid forms? Well, to help us do this, we have several versions of the variable. We have the tightest definitions, which are just the very, very liquid forms of money. And as we add less liquid types of money, we then have broader measures. So we split the money supply into categories, nested categories where liquidity is the defining factor. To help you visualize this, we can list or break down the UK money supply using ECB measures, and these are from July 2008, so that we can understand how broad money encompasses less liquid forms plus other less liquid assets. So for instance, currency in circulation for the UK was 43 billion, but money in bank accounts, that's electronic money, was 948 billion. Now we can see that overnight deposits far dwarfs the amount of currency in circulation, because in reality we don't need that much money to carry out all of our economic transactions in each year. If we just include those two, we have the tightest form of money, which would be called M1 in Europe or M0 in the UK. As we add savings accounts or deposits with agreed maturity up to 2 years, after 3 months notice, we can add another 700 billion, so that M2, which includes other types of deposits, is 1.6 trillion in the UK in 2008. And then if we add other kinds of money market funds, commercial bonds, repurchase agreements, that kind of financial innovation, which are quite close to cash, we can have a much broader measure, something like M3, or also called in the US M4, which is 1.9 trillion in the UK in 2008. And we can see an example here, the difference between currency in circulation and overnight deposits, but why money has no physical backing, so it's something known as fiat money. And so much of it we cannot possibly arrange for another asset like gold to back money. It's not practical. To look at this with a time series perspective, we can see for the UK the growth rates of the money supply, including inflation here in the red line. But in context, we have green line, which is broad money, which includes deposits from firms that are created by bank loans, and M0, which is cash in circulation and the tight money, and the bank deposits, which stays roughly the same. The growth rate in the money supply is roughly the same across time. We can see the blue line here grows around 5% on average, though in the financial crisis we can see that the central bank increased the money supply by more like 7.5%. But there's a real story going on with broad money, which includes loans made to businesses and the deposits created by those loans. M4, which is broader, is growing at a much faster rate before the financial crisis, but then there was destruction of the broad money supply by banks calling in loans, and that's never recovered. In fact, broad money has continued to shrink since the financial crisis. Most countries have a central bank, and the central bank maintains the country's currency. As examples, we have the Bank of England for the UK, the European Central Bank for Europe, and the Federal Reserve Board for America. Normally, the central bank is not part of the government, it's independent central banks, though this is not always the case. The Bank of China is part of the government. So different countries have different institution types. The central bank is the only institution with the right to print currency in the country, so notes and coins in circulation are printed by the central bank and the central bank only. The central bank is the institution that controls the currency. Any new money will be distributed into the economy through the commercial banks, who are intermediaries. The central bank is also the bank of all commercial banks. So every commercial bank must have an account at the central bank, where it must keep its reserves. And the central bank is also the government's bank. When the government needs to borrow money, it goes to the central bank for the cash. What are the roles of the central bank? One is to oversee the stability of the monetary system and also to regulate the commercial banks and other financial institutions such as insurance companies. It also has a remit to keep price stability in the country, so it carries out the country's monetary policy, increasing and decreasing the money supply in order to control aggregate demand with the aim of keeping prices stable. The central bank has a range of tools at its disposal to keep the money supply in check. How does this work? The central bank has three tools to change the money supply. It can use open market operations, the buying and selling of government bonds. For instance, if it sells bonds, paper goes into the population and money comes back. It reduces the money supply. It can change the rate at which it lends to commercial banks, and it can change the liquidity requirements for the commercial banks. For instance, tightening the amount of money that's required to be held back stops commercial banks from lending, and that changes the money supply as well. Why does the central bank change the money supply? Well, it's to enact monetary policy. If it wants to expand the economy, then the central bank will embark on expansionary monetary policy. In other words, it might increase the money supply to increase aggregate demand and increase output or lower unemployment. Similarly, if the economy is heating up, the central bank might carry out contractionary monetary policy, in other words, reducing the money supply to reduce aggregate demand, and that might be to keep a lid on price rises in the economy. We could look at that diagrammatically in the money market, or the market for central bank money. The rate of interest is on the vertical axis and the quantity of money is on the horizontal axis. The rate of interest is the price of money, that's why it's on the vertical axis. We assume the supply of money is exogenous, independent of the rate of interest, and that the central bank has total control, so it can increase the money supply, and in this case we see the money supply shift to the right. If the money supply was reduced to reduce aggregate demand, then we see the money supply schedule shift to the left. We now turn to the commercial banks and show how they create money using loans which create deposits. So it is the central bank and the commercial banks that are players in the money market with the ability to control the money supply. The central bank, through printing currency or high-powered money, distributing that through the commercial banks, and the commercial banks creating money through the setting up of bank accounts or loans to businesses. We start by understanding that commercial banks can lend a percentage of any money paid in the form of deposits from customers. They can lend that out. And we're now going to show an example of how that takes place. So we start by imagining an economy or a country where there are no banks. And so there is no money in the form of bank accounts, or there's no money in the form of bank deposits. The only form of money, in an early economy, is in cash, and that's in notes and coins. It's in circulation in the population. Further, we make a simplification. There's exactly £100 cash in the economy, and that's all in the hands of Jane. So we know that the money supply, quite intuitively, is equal to £100. Then there is an innovation. The first bank in the country opens, called FlatWest, and Jane decides, for one reason or another, to put that money into the bank. Maybe it's more secure to keep it in the bank, so she deposits her cash of £100 into FlatWest. What does FlatWest's balance sheet look like? Well, FlatWest has liabilities and assets on its balance sheet. It owes £100 to Jane in the form of deposits, but it also has £100 in the safe or in the vault, in the form of cash, which is taken from Jane. So assets are equal to liabilities, assets equal to liabilities, and they're both equal to 100, so we have a balance sheet. This is a good time to reflect on our calculation of the money supply. The money supply is the sum of all the cash in circulation and the bank deposits. So even though cash in circulation has dropped by £100, deposits have increased by £100. So the money supply is still £100. And if the bank was forced to keep Jane's money in a safe, then that would be the end of the story. However, the bank realizes that they can lend out Jane's money if she doesn't withdraw it on a daily basis. So instead of just leaving the money in the safe, they can lend it out to another firm, and this money can be used in a productive way. Obviously, the bank can't lend out the full £100 because Jane might want some of her money back. There has to be some money at the bank in the safe. In fact, it's a legal requirement. The government or the central bank will specify that some money ought to be kept back. It insists that the commercial banks keep some reserves in case of loan default. So FlatWest lends 90% of its deposits to John and keeps the rest in the form of reserves. Now we have the balance sheet. The liabilities are still £100, but the assets are now split between reserves of £10 and a loan to John of £90. So this bank is owed the money, it has assets. But when we add up the liabilities and assets, we still have £100 in each column. But what has happened to the money supply? Let's calculate the money supply again. We have cash in circulation is now £90 because John has been lent £90 and that is circulating in the economy. But Jane still has £100 deposited at the bank. So the money supply is actually £190 now. And what has happened is that the loan made by the bank has created money. So the commercial bank has created £90. Of course, the story does not end there because the money continues to circulate. John uses the cash to buy some equipment from Kate, and Kate deposits that money back into FlatWest. So let's look at the balance sheet again. Here we see a more complicated balance sheet. Jane still has a £100 deposit. There were reserves of £10 in cash and a loan made to John of £90. John gave the money to Kate, who then brought it back to the bank and deposited in FlatWest, which means that the reserves have also increased by £90 again. And we can see this reflection here under the totals for liabilities and assets of the increase in the money supply. Now that the money has come back to the bank, Kate has deposited the money, there are higher reserves again. And we can appreciate that the bank will lend out some of those reserves. In fact, it can make a loan of 90% of the new reserves, which were £90, so the bank can make another loan for £81. So the money supply is now £100 as a deposit, £90 as a deposit to Kate, and there's £81 circulating in the economy through the additional loan that the bank has made. So the money supply is now 271. And of course this cycle will go on repeating itself. The bank will continue to make loans and this money will find its way back as deposits. And even though the increase in the money supply is smaller each time, the process continues. So how much will it increase by after the new deposit of £100 in the first instance? At each stage, the bank keeps 10% of the new deposits. So in other words, this is the leakage. Every time the deposit comes back, it becomes a reserve, but only 90% of that. So 10% is leaking at each stage. And we can write the process that the eventual amount of money will be the £100, which is the initial deposit, plus 90% of the new reserves it's created, plus another 90% of any new reserves created from the deposit of this money that was lent out, and so on and so on and so on. In fact, that will be equal to 100 times 10. This is a progression, and will give us a solution of 1000. Or we can write this mathematically, that the bank multiplier is equal to 1 over the liquidity ratio. Well, the liquidity ratio is 0.1, that's 10%. 1 over 0.1 is equal to 10. So the bank multiplier is 10 when the liquidity ratio is 10%. So a new deposit of £100 will create money to the tune of £1,000 by the bank multiplier. We can also use another form of multiplier called the money multiplier, which is a close cousin to the bank multiplier. It tells us that the change in the money supply, given the change in a monetary base, remember the change in the money supply was here, change in monetary base was 100, is equal to the change in deposits plus the change in cash in circulation divided by the change in reserves plus the change in cash in circulation, or cash held by the public. That's another form of multiplier. So the money is multiplied by 10 because of the commercial bank's liquidity ratio of 10%. And notice that the amount of money created depends on that liquidity ratio. So the higher the fraction of reserves that must be held by the commercial banks, the lower the multiplicative power of the money creation. If the banks were forced to keep that 20%, then there would be a higher level or a higher leakage from the process of money creation. Banks had forced to keep more of the money in each round. So it's this reserve ratio or liquidity requirement that controls the amount that commercial banks can create. If you look at the financial crisis, up until now, we've assumed that all the money lent out to John, etc., is safe and that it will come back. What happens if it wasn't safe? If John lost that money and was unable to pay it back to the bank? Well, there would be a big hole in the reserves for the bank. So the bank would become insolvent. And this is what happened in the financial crisis. If there's a significant risk of default, in other words, some of the assets, which are loans in the commercial bank, are subprime or toxic, a large-scale default can create bank insolvency on a mass scale. In fact, that's how the financial crisis of 2008 happened. Just the fear of default can drive the commercial banks to hoard cash, to try to include, so they will bring in loans, allow people to pay off loans without issuing new loans, trying to increase their liquidity to ensure against defaults of loans. This results in a fall in the money supply, and a fall in the money supply will give us lower aggregate demand, and in this case a big recession. We now turn to the demand for money, a theory that's come from Keynes, 1936, in his general theory. There might be three types of demand for holding money. A motivation. There is the transactions motive. People demand money to carry out transactions in their day-to-day business. There is the precautionary motive. People holding money for unexpected expenditures or rainy day. Of course, the cost here is foregone interest, because if you keep cash under the mattress, it's not earning interest. There's the speculative motive, in order demanding money to use to buy or invest in assets with a return, such as shares in firms, which might be more attractive at lower interest rates. But how does money demand change or behave? All three motives add up to total money demand. The total money demand is depending on things like income, maybe nominal income, and interest rates. As examples, if prices rise, then we're going to need more money to carry out the same transactions as we did before. So there'll be higher demand for money. If income rises, there'll be a greater level of economic transactions, giving us higher demand for money. If interest rates rise, then we might prefer to put our money in a savings account in a bank rather than use it to buy assets such as shares. So money demand will fall. If inflation is going to rise in the future, if we're expecting in future prices to rise in the future, then we may bring forward our purchasing decision, and this may increase our demand for money. Or perhaps the risk of alternative assets has increased, in which case we would prefer to hold cash. Imagine a liquidity crisis like the financial crisis of 2008. We would prefer to hold cash rather than put it in the banks that we feel are unsafe or insolvent. We're worried about the banking system. We prefer to hold cash. It increases the demand for money. Let's look at the demand for money in the money market. In interest rate money balances space, money demand is downward sloping in the interest rate, reflecting that at higher rates of interest, we prefer to bank our money maybe in a savings account, so our demand for money is lower. As interest rates fall, holding money becomes more attractive or less costly. So we prefer to hold cash and money demand increases. We now turn our attention to the financial markets by analysing equilibrium in our money market for central bank money. The financial market that we're considering is the money market, which is the market for central bank money. We can put together the supply of money and the demand for money in one two-dimensional diagram and have an equilibrium in the money market. So there'll be an equilibrium interest rate, which is the cost of money determined in the market for money. Essentially, that is the price of money, because if we hold cash, the cost of holding that cash is the foregone interest. It becomes the price for holding money. Remember that the money market is only central bank money, so we can think of that as narrow money. It does not include assets such as considered or included in broad money, such as commercial bonds and other forms of paper, or the deposits that come from loans to companies. There is money market equilibrium. We can see in interest rate real money balances space, money demand and money supply come together where they interact. We have the equilibrium interest rate in the economy. Now we can use the money market to look at how, when there's a change in money supply, what effect that has on the equilibrium interest rate. Remember, the expansionary monetary policy is increasing the amount of money in the economy with the aim of increasing aggregate demand and increasing output. And for that we expect the interest rate to fall. In contractionary monetary policy, the quantity of money in the economy falls, aggregate demand falls, and so will output, caused by an increase in the interest rates. We can now use the money market to analyse monetary policy. It starts off in equilibrium in interest rate real money balances space, where money supply is equal to money demand, we're at interest rate R1. The central bank wishes to cool the economy, so reduces the money supply. At the old interest rate, there is now excess demand for money. There's a difference between money demand is greater than money supply. Because there is excess demand, people preferring to hold money, in order for people to let go of it, banks will have to make interest rates higher to make switching into savings accounts more attractive. But this pushes the interest rate upwards. And we see now how a reduction in the money supply is consistent with an increase in the interest rate. a cause for an increase in the money supply, it is the opposite.